A Quaker, a Methodist, and a modern day California hipster all walk into a bar. What do they have in common? Socially responsible investing. Despite the fact that many of us think of this as a modern day fad, the idea of being an impact investor, of influencing social change with your dollar, has been around since, well, the beginning of time. Moses himself is credited with writing guidance on how to be a good investor. In the 1800s, the Quakers forbid investing in companies involved in slavery and wartime. SRI is even credited with combating apartheid in South Africa. What was once seen as a radical idea is increasingly gaining popularity. A 2019 survey by Morgan Stanley found that 85% of individual investors are interested in being socially responsible investors. Enter ESG, the easy way for the average investor to be socially responsible. ESG funds select their underlying investments by using, yes, quantitative financial factors and qualitative social factors. There's three pillars to ESG: environmental, which is like carbon footprint, renewable energy, water-related issues; social, which is employee treatment, safety policies, diversity and inclusion; and governance, which includes things like executive pay, conflicts of interest, and transparency with shareholders. Understandably, this would be very hard for the average investor to track. No worries, there's a Morningstar rating for that. Whether you are an individual investor or retirement plan committee member, ESG funds and socially responsible investing is a topic we can no longer avoid. So let's go ahead and address the elephant in the room. As a fiduciary to a 401k, the simple goal of being an impact investor is not enough to include ESG funds in the lineup. As reiterated by the Department of Labor last year, fiduciaries, and I quote, must remain focused on the financial interests of participants rather than policy objectives. So what is the case for ESG funds? Are they a good buy? BlackRock seems to think so. In an open letter last year, they concluded that sustainability portfolios can provide better risk-adjusted returns over time. Other advocates point to the reduction in catastrophic risk, the idea that ESG screens will help avoid the potential for a catastrophe to sink a company's proverbial ship or oil rig. Take the case of BP, or if you're a movie buff, the movie Deepwater Horizon with Mark Wahlberg. Prior to the oil spill in 2010, BP's ESG rating was downgraded regularly for not reacting to a series of smaller accidents and for outsourcing the maintenance of the rig. ESG proponents describe this as one of just many examples where using ESG screens could have protected the investor. On the other hand, opponents say not so fast. The well-established financial journalist, The Institutional Investor, argues that despite countless studies, there has never been conclusive evidence that the screens deliver alpha outperformance. In fact, studies show that ESG funds trailed the S&P 500 by 1.5% from 2010 to 2019 and exhibited the same level of volatility. Opponents say that any outperformance by ESG funds in recent years is due to their heavy tilt towards tech stocks and the COVID-driven tech boom. My opinion is that we don't really have enough historical data to determine whether or not ESG will generate alpha over the long run. But I do personally believe the concept is more than just a market ploy or good branding. Investors are interested, which means retirement plan committees and advisors have to be interested. But with all things fiduciary, due diligence and documentation are paramount. If you have questions about ESG funds, give us a call. That's it for this week. This is Jeannie Fisher, the 401k lady.